experts on the panel now. Neeraj Gambhir of Axis Bank, Jairam Sridharan, CEO, Piramal Retail Finance, Anubhuti Sahai of Standard Chartered Bank, Rajiv Mohan of Kotak Mahindra Bank, and Soumya Kanti Ghosh of State Bank of India join in on the show. Gentlemen and lady, thank you very much for joining in. Neeraj, first question is, I think the big focus now and the big takeaway is that the RBI is squarely focused on achieving that 4% inflation band. In the speech, he called it that Arjuna's eye. There is no reason now to be tolerant, intolerant now. So what are the implications of this? Are we in for a longer pause by the RBI? And when do you think a rate cutting cycle can begin? Neeraj, you're on mute. Kindly unmute.
Apologies. You can hear me now, I hope.
Yes, we can hear you.
Clearly, we are in for a longer pause than what we initially anticipated. I think the fact that the growth momentum is continuing, and Reserve Bank is fairly confident that the growth momentum will continue in the months to come. I think that's giving them the confidence to say that let's stay focused on inflation for now, because growth does not seem to be a problem. I do anticipate that at some point in time, if the growth impulse sort of weakens somewhat, that's the time for us to start thinking about any kind of a rate cut at this point in time, particularly given the fact that forward forecasts of inflation at this point in time is also somewhere close to 5% and not 4%. And Reserve Bank continues to be very focused on getting inflation, as the word used is aligned with 4% target. So I do think that if any rate cut, it should be in this somewhere close to, let's say, February or March of next year. But that will be highly contingent upon many other things playing out, particularly if we see growth momentum weakening. If growth continues to be strong, inflation continues to be closer to 5%, I think we will have to recalibrate whether even February or March is a possibility.
Okay. Thanks for that, Neeraj. But more or less, those are the questions in everyone's mind. Soumya, a similar question to you. I think one giveaway from Dr. Patra was that we want inflation to align towards the target of 4%, not be at 4%. That was the only somewhat dovish statement we got. But your idea as to when we should expect a cut and any other takeaway?
Yeah, thank you, Lata. I think one interesting takeaway from the policy statement, as I understand, I think if you look into the paragraph 12 and paragraph 14 of the policy, paragraph 12 talks about the growth the factors, positive and negative, and paragraph 14 talks about the inflation factors. In fact, in paragraph 12, we'll find that the growth supportive factors are somehow more in number than the growth negative factors. And in paragraph 14, the inflation supportive factors are somehow a little less than the inflation negative factors are more in number than the inflation supportive factors. So somehow the Reserve Bank is convinced at this point of time that the growth momentum will continue. And as expected, like a central bank, they have expressed a little bit reservation about the inflation number. So I think that's a smart way of communicating to the market that, it has just stopped short of upgrading the projections if done at a later date. So my sense is that aligning with the 4% target that the Deputy Governor pointed out is a smart way of communicating at the market that the market should not run away with a rate cut expectation at a future date. And my sense is that, rate cuts can now wait, because if we continue to have this growth momentum continuing and inflation continues to fall in the first half as projected, I think then there is no harm in continuing with this at this rate for a longer period of time than what the markets are anticipating.
Okay. Got that. So you would say it is a bit hawkish on the margin compared to what you thought pre-policy?
Yes, as expected, I think the RBI has actually done the correct thing by communicating to the market that it's not good to run away with expectations of a rate cut at this point of time when we have got a grip on the inflation, and I would like that grip to continue.
Okay, yeah, actually you hit the nail on the head when somebody asked that actually there have been cuts in deposit and lending rates by some banks. The response from both Patra and the governor was that is why we mopped up the liquidity so quickly. Rajiv Mohan, your thoughts on that? They will clearly frown on deposit and lending cuts in this context?
Hi, Lata. I don't think it's a question of frowning. It's a question of messaging as of now. And RBI has been very clear that inflation stays primary, stays on the focus. And they have been harping on the fact that risks are evenly balanced. Despite that, between the policy before the last one, the Q4 inflation number was 560, which is brought down to 520 and held at 520. But the number from 5% for Q1 is now at 460. I think they are seeing inflation moderating, but they would like to see more of it. And Governor kept stressing on the fact that it has to be sustainable. Having said that...
Yeah, that was my last question to him. Yeah, go ahead, please.
I would expect all central banks to be wanting to support growth, but inflation somehow remains their passion. So they would want to be guarded and data dependent.
Okay. Any guess on how do you see the 10-year yield moving now over, say, the next quarter? Rajiv?
I don't think the 10-year expectations would go anywhere. It was still a trading range. I would put it in a 10 basis or a 15 basis moving range from where it is currently. So roughly 685, 715.
Okay. Neeraj, what would your range be, say, year-end range?
I would think that so we have to see how the liquidity plays out, right? At this point in time, we had this positive surprise from the 2,000 rupee notes and some government spending. But before this, we had a lot of concern around how the liquidity plays out, right? And if that results in Reserve Bank doing OMOs in the second half of the year to support the currency creation and the primary money supply growth, we could be in, say, around 675 or thereabouts. But if the combination of sustained 2,000 rupee note reversal liquidity and foreign exchange intervention does not warrant that intervention by Reserve Bank, then I think we could be somewhere close to the current level of about 7%.
Okay, so you're even seeing 675. Okay, Anubhuti, anything we've missed out, your key gleanings from the press conference in the statement?
I think if we look at this hawkish pause, we need to look at the broader context. Probably the MPC just didn't have any other choice but to sound hawkish, especially given the recent downside surprises in inflation. The next print due next week, probably it will be fourth quarter. That could have led the market to think about rate cuts sooner rather than what RBI would have liked to see. Secondly, there is a liquidity surplus which is weighing down on the call rates. Thirdly, the deposit rate cuts which you talked about. Fourth, you have the monsoon uncertainty. Core inflation is fine, it's closer to 5%, but if you exclude transport and communication, that is still sitting close to 6%. If there is any surprise, negative surprise on monsoon, we can very quickly see a surge in headline inflation. So I think, the caution which we are seeing on inflation is well justified. And, if we look at the RBI's forecast, the full year forecast adjustment is simply a technical adjustment taking into account the downside surprise in Q1. But if you look at the Q3 and the Q4 forecast, that has remained unchanged, which effectively, to me, gives a message that they are not extrapolating the recent downside surprises to the second half inflation projection.
Fair. Yeah. That was my specific question to the governor. Considering the core inflation fell so sharply, or at least the fall in April was led by core inflation, why aren't you extrapolating? And the answer from both Dr. Patra and the governor was they want to get this El Nino uncertainties out of the way, and that's why they've not changed those forecasts. And I think you gave me my headline. I think the best description of the policy is hawkish pause. A final question to you, Jairam, and I think this will be the most important one, because after all, everyone is wanting to know what will be the cost of capital for NBFCs like yours. Will it be more expensive to borrow from now on? What do you see? How much do you see the cost rising or falling? And for an EMI payer, what is the delta that you can guide for the millions who are watching now?
Sure. Thanks, Lata. the way I was thinking about this today morning coming in, I was like, we should expect to see an Amol Palekar film. Some calm script, no drama, and no dishum, and that's exactly what we saw. And we are kind of, I hear the point about a hawkish pause, etc., but it seems like we're looking for to play villain role. It's like there's not much here. It's a very, very calm, exactly what one expected. Kind of policy, and the market, if you see from a pure liquidity perspective and what's happening in the secondary market, rates have already been softening. Things have been getting a little bit easier. The 2,000 rupee notes thing has helped. Banks have seen a little bit more deposits. So on the whole, the situation for NBFCs from a borrowing perspective, has been a bit calmer in Q1 than I was expected coming into the year, and I think for the EMI payer, was seeing multiple increases in rates and repricing over the last 6-9 months. I think no news is good news, and in my view, if this continues and the secondary market remains relatively benign as it is right now, in a good case scenario, folks can, from an EMI perspective, expect a little bit of a Diwali bonus.
Okay, there was an audio problem. I couldn't get it entirely. So let me just toss that to Neeraj as well. Neeraj, if somebody were to ask you, will my EMIs go up? What would you advise them? Likewise, generally for a corporate cost of capital.
I think the bulk of the rate adjustment that had to happen is behind us, right? As far as the retail investors are concerned, because most of them are linked to repo rate, I think we've seen the change. We are not forecasting any repo rate hikes. So I think that sort of augurs well for the individual borrowers. As far as the corporate customers are concerned, because a lot of them are linked to MCLR, and MCLR is yet to adjust for many banks and for certain tenants, I think there could be some upside left in terms of readjustment of MCLRs. But fundamentally, I think we are in a very stable interest rate regime now, both from deposits as well as from lending side, at least for the next few months. And I think it could, as the governor mentioned at the start of his policy, that the future looks a little bit more clearer than it has ever looked in the last 3 years, right? So I think we hope that this continues for somewhat longer.
Okay. Thank you, gentlemen, and Anubhuti, for parsing the governor's press conference as well for us. Soumya, Rajiv, Neeraj, Anubhuti and Jairam, thank you very much for speaking with us after the press conference. The best summary of the policy is that it is a hawkish pause. So there is no rate cut coming anytime soon from what the governor said in the press conference as well. And for those of us who are interested in a home loan, the clear indication is rates are likely to be stable for now. So you can take your time to make your decision. Thank you very much for watching this special coverage of the Reserve Bank's press conference after the monetary policy. After a break, it will be time for Business Lunch.